Mic test, mic test. Good evening, folks. Or should I say good morning, champions. You guys are really awesome for joining in, tuning in, sacrificing a dinner, or you would have pulled a quick dinner to join us. Kudos to you guys. Tonight, we will have Peter with us sharing on his view on the third market outlook strategy. I myself is Adrian, your friendly market analyst that looks in the market for more shorter term ideas. Just for a disclaimer, most of our webinars are all held and also run by our own analysts, and all of us are licensed by SC. Myself and Peter holds the advisory license, while our gorgeous Isabelle holds the dealing license. That she will be joining us on a later part to also share how can you maximize your performance. All right, so I guess everyone can see my screen on the disclaimer. Yeah, disclaimer. I always get people to you know what to do with it. Where is my screen? To print it out, stick it at your toilet door, stare at it, understand it. Yeah. These are the awards that we have been gunning and won, and we're striving for more. The year is not ending just yet, so more to come. You guys are our greatest motivation. All right, just to dive in a bit before we start with Peter's session, our head of research. A quick view of the four markets that I'm going to talk about quickly: Dow Jones, Hang Seng, and also Straits Times and FBM KLCI. Looking at Dow Jones is going on a beast mode, all-time high. There's no reference of its resistance already soon. So we can actually look at the pivot technique to actually look at where is the next level of resistance. In this case, I use a weekly calculation for the pivot technique. So the next level that we can anticipate is actually at 45502 level. The candle is a bit strong and the stochastics is turning up really well. So let's see. Beast mode. So there's something to expect for Dow Jones. Hang Seng, at the beginning of the week, I actually made a statement that I want to be a bit more conservative due to the candlestick that was formed when we highlight about it, which is a bit of a shooting star dodgy, but the cautiousness was proven wrong. It rallied all the way beyond the resistance level of 24928, and now it's actually trying to reach 26257 levels. Having said that, the next this Friday and Saturday is actually critical. I will still be a bit more cautious because you can see there's a bit of waning in momentum already. The first little red candle is forming, so we want to watch it a bit more closer. Next one will be Singapore Straits Times Index, all-time high, and all-time high. I guess the fund flow there is very robust, as opposed to what we used to think that Singapore market is actually very boring. It's not, looking at how it has went up. So I use the same technique of reference of where we can check out the next resistance level. You can look at R34325 level. So in any case, you can see stocks like Apple or SIA, SATS, all these have moved really well. The REITs are also going quite well now, partly because of potential rate cuts around the globe. Yep, I think we have cut to 25 basis points. Okay, coming back to our home ground, KLCI. This is a quick downtrend line that I draw, which is really ugly, but I think you can appreciate what I'm seeing here. There could be a potential break of that trend and shift. Partly, I think after the announcement of the PMX surprise, which I think the market has kind of taken it quite well. There is some rebound, and like I've always highlighted, the banks is something to look out for, and we might want to check with Peter and us. So yeah, just before I end the my session and pass it to Peter, we have some campaigns going on, like Wake Up to Go for our dormant clients, and you can check it out. First come first basis, 600 gold coins waiting up for grabs. For those are actually trading on Singapore market, this is the last month to actually work on it. We will be visiting XJAC's office. I will be there to welcome you, or maybe I might not. So guess. If you want me to be that, you can actually vote 1 or 2. Well, KDI is our financial app where everything is going to be under the roof. And do try to get 44%. I always urge people maximize your wallet performance. And lastly, a quote for the day: an investment in knowledge pays the best interest. And yes, thank you guys for paying yourself this good interest. And I'll pass the floor to Peter. Hi, Peter, the floor is yours. Thank you for spending your time with us tonight. Hopefully you have already had your dinner.
Hello, thank you. Thank you for that wonderful introduction, Adrian. For those who have not met me before, I am the head of research at Kenanga. Very pleased to meet you. In this session, I will be able to hopefully share enough insights with you, especially what the foreign investors and the local institutional funds are sort of thinking. What are also the feedback and the pushbacks that I have received over the period of the past 2-3 weeks that the team has been meeting with no less than about 20 different funds, right? From our what we would like to call marketing as well. Just like we are marketing to yourselves, we have also done our rounds with the Insti side. So in that sense, this hopefully can give you more insights that will be valuable to you. I would like to maybe now just put up my slides, if that's okay, Adrian, to start off the presentation.
Yes.
Yes, okay. If you do see it
Very
now, okay, that's good. Let me just make it maximized. I think the name of my presentation today, guys, I have entitled it Bounce Back, and I will explain shortly why I chose that as my title. But I think for us to really appreciate what sort of equity strategy we should use, it oftentimes cannot be viewed in isolation from the economic realities and also what markets is expecting and also what investors view the current conditions on the ground as. So I think we will start from there. My three-pronged presentation, hopefully for the next 40 minutes or so. We start from market conditions, and then that gives us a snapshot in time of where we are, what happened to the KLCI, what is happening right now to expectation on earnings, etc. Then after that, we can look at what then is the market thinking on a forward-looking basis, right? How do we think about rate cut? How do we think about the ramifications of tariffs? What sort of feedback has Kenanga gotten on the ground? And how do we think about the tariff rates that are being bandied around currently that seem a little bit unfavorable to Malaysia? Then after having gone through all that, then I'll take us through the equity strategies, and how do we navigate, especially the third quarter, right? I will then go take us through our key picks, our key sector plays, and also share with you where I will weave into my discussion all the feedback that I get from the fund managers. So yeah, without further ado, let's dive into it, guys. So number one, market conditions today, right? For all of us who follow multiple markets, it wouldn't be a stranger to the idea that Malaysia currently is a laggard a market. We can only be proud that we are slightly better than Thailand, but we know that Thailand has got its own set of domestic issues right now. Now, this chart I have here may be a couple of days old, but the story is roughly the same. That if we take the view of since Liberation Day, right, where Trump on 2nd of April gave the whole world a summons, right, of what is the actual tariff, most of the countries have recovered, Malaysia included. In fact, in that timing, since April, the small cap index, as you can see here, where I've boxed up, is actually recovered a little bit more. That is one of the observations, right? So there is a little bit more appetite for a bounce back in the smaller cap space. Of course, if you take a year-to-date view, you might reach the conclusion that small caps have also, in the red bars, dropped off a bit more. But the climate today is one that most of the markets are up, so it will give us a little bit of a time to maybe just pause a bit and look at the conditions around us, because we do not want to get too complacent, right? All the markets are now better than the tariffs when it was first announced. And some would even say that in the US, people are completely desensitized for the fact that, the US market seems to continue to climb higher. Now, of course, when we are looking at the market as a whole, when I speak to my institutional fund managers, some of them, these are my clients. Some of them, they might hold funds that they cannot hold too much cash. Some have mandates that they can only hold a certain percentage of cash. And within those that I speak to, I think generally what had happened in the early part of the year up to maybe April, funds were cashing up, meaning to say they were selling some stocks and they were keeping more cash liquid because they didn't really know what was going to happen during April 2nd, right? What would Trump really want to do? So there was more liquidity that was being stored up. At the time, obviously, what it then translated to was fund managers took their cash levels higher from high single digits to maybe low to mid teens. Some more aggressive ones took it up to close to 20% for those that can hold cash. Today, we're at the levels I would say I would describe as maybe low teens. In my conversations with fund managers, meaning to say that they are not exactly putting full money to work yet, but there is already this thinking that they have already gotten their cash to quite a high level. So the tendency is to see when to deploy rather than take money out of the market. That's number one. And of course, if we want to look at the numbers to back that up, on the top right chart, you would see the place where I circled. Essentially, when the blue line, which is actually a ratio of money, broad money, M3, for those who look at economic terms, and I take that over the market cap of Bursa, such that you get the idea of how much liquidity is being put into work. Therefore, as it climbs higher, that's when you know more and more liquidity is not being put to work. And right now, it's kind of plateauing. So that's actually a good sign, meaning that people have started to deploy some into the market. So that's where we are today. Of course, who is coming into the market is the second question we need to understand a bit better. If we just look at very broad statistics from Bursa, it may be slightly unable to help us reach a proper conclusion. If we look at the foreign foreign shareholding, yes, there is a decline from when we started off this year at about 19%, by about zero point 0.5 percentage points to 19.2. That alone is quite a steep decline. But I think where we perhaps want to zoom in is to look at how that decline has been not even across the different sectors. This is to help us understand the investment psychology. So if we look into some of the larger cap stocks that the foreigners care for, what we can see is I put two columns here. The first column is the year-to-date change in foreign shareholding, and the last column is the actual foreign shareholding as of May or June. We will see that because of the fact that Malaysia's stock market is quite largely dominated by finance stocks. The fact that Maybank, Hong Leong Bank, CIMB, Public Bank, for example, has declined, that is why the reason our markets drop seem to be, in relative terms to other markets, more severe, even though when we look at it on a broad blended basis, the drop is about only 0.5 percentage points. Of course, having said that, there are some exceptions to the trend. We know right now RHB, for example, where most insti investors look at it as a dividend stock, TM, a stock that is also fitting into that mold. Nestle, very stable consumer stocks. On a year-to-date basis, those have been stable. So it tells us quite clearly that the mood right now is not yet for growthy stocks by the foreign investors, whereas the value type of stocks, which are those that are relatively stable and mature, as well as being able to promise high dividends, are the ones that will give you less volatility, right? So this is the view from the foreign lens. Of course, those who track foreign flows will also know that there has been foreign outflow with sporadic inflows. Those gray charts on the top right, top left, would give you that perspective. I think right now the Malaysia side, the inflow has been into bonds, and that has been slightly more apparent. When we look at the small caps, majority of the IPOs this year, despite a very strong year, haven't seen really good action. In fact, at one point, I counted about 70% of IPOs were still underwater. That is a reflection of a more cautious retail investment environment. And the reason why I say that is because most of my clients on the fund management side typically have certain thresholds that they will consider before coming in for retail IPOs. Some of them would say, it's closer to that 200 million market cap range, for example. So anything much smaller than that, usually there isn't a lot of trading interest. One good news, however, or a silver lining, is that today our retail participation, meaning to say the mix of trades that are done by the retail side is already as low as it was in the past 10 years. So we are hovering around the 18 to 19%, and we expect that moving forward, there will be some positives here as well. And I shall explain my next slide. Well, if the April tariffs was something to be afraid of previously, most of the investors were waiting on the May or the first quarter results season to see how earnings were adjusted lower in terms of guidance and expectation, because from the time that Trump had come in until when the first quarter results were shown, there most of the changes in target prices by brokers and also valuations were mostly on PE, or price earning ratio changes. There was little of earnings cut. And usually after the first quarter earnings, the silver lining here is that the actual earnings recalibration had the opportunity to take place. The reason why earnings guidance is still very important and up to the first quarter is because for the past 2 quarters now, and very clearly for the first quarter results, every 3 out of 4 names that missed expectations during earnings will see their stocks being sold down quite noticeably. That means that the sensitivity of the market investors to negative performance versus guidance is still very high. And therefore, it was a difficulty that had to take its course. Market earnings have been adjusted down. For those who track broker estimates, I think we started the year at about 6 to 7%. I think today we are about half of that in terms of KLCI earnings growth. Um, one, of course, at this moment, as I have also mentioned in my first slide, that the small caps have rebounded stronger. It does look that that is supported by some reasons. If you look at the top graph, the gray and the red lines, respectively, representative of the KLCI as well as the small cap valuations, PERs, or price earning ratios. And you can see today that even the smaller cap PERs are more palatable. They are lower, right? They are less expensive. But not only that, they are also in relative terms normalized versus the larger caps. In a more simplistic way of putting it, we started the year with the smaller caps being relatively pricey. So once the first quarter was done and dusted, what we then saw was the expectation on a valuation basis have come down to a more normalized levels, and that is shown by the gray area over here, being the difference between large caps and small caps. So whilst the past 2 quarters we haven't been pushing a lot of of small cap. This quarter, we have pushed some of these small caps a little bit more aggressively, and those some of the names are displayed below, but I will have another slide later to go into more detail. Yeah, so that is the recalibration that had to happen, and that is the market conditions we are today. What can we expect of the market? Now, in the market, this chart is a relative chart. What you're seeing here is a lot of numbers, but bear with me a bit. The very simple message here is after a rate cut, so long as it is not a recession scenario, it is always time to buy the market. Previously, in these four OPR cuts that we had, on a 12 months basis, the KLCI was able to return these amounts over here. As you can see my cursor, that was the returns, except for the 16% drawdown, which was during pandemic, right? Because pandemic, 12 months outside of the pandemic, we still haven't fully recovered yet. So this this helps us put a perspective, and that is why also hence the title today of bounce back. So long as we do not think that it's going to be a pandemic level sort of difficulty, the market tended to bounce back. The table you see on top is to help you form a holistic picture. What historical pattern tended to teach us about how sectors perform relative to the market? So you would see the sectors to the right, like for example, financials, construction. Those are some of the sectors that tended to outperform, whereas some of the darlings today, such as utilities, healthcare, on a longer term basis, 12 months, they tended to underperform. So this is a reason for us for those investors that hold a 12 months time frame to give us some confidence of what we can expect in the longer term time frame. However, I also have to caveat that a lot of investors do not get judged on the 1 year time frame when because they are assessed sometimes monthly, sometimes quarterly. So it is still important for us to look at a third quarter sort of environment. I will speak about that environment shortly in this slide. Now, what I want to show in this slide, if I was to use a more simplistic way to help everyone digest, is that in the third quarter, truthfully, no one really knows for sure whether another rate cut down somewhere down the road in Malaysia will be necessary, right? Our house view is that there shouldn't be any rate cut. And for those who have been following the rate cut news, the recent one done by Bank Negara had also been preemptive. So we have confidence that after the first quarter and second quarter GDP that looks fairly acceptable, we will still be able to avert another rate cut for the rest of 2025. However, markets will always think ahead and maybe take a bet or maybe take a position to suggests that there could be a small chance, however slim, of another rate cut, right? And typically, actually the bond market is a better leading indicator of whether a rate cut will happen. On the top chart, I have just the thing to pay attention to is actually the blue shaded areas. Now, the blue shaded areas in very simple terms are the times where the market in the bond side is expecting the OPR or the Malaysia interest rate to go further down. And why that is, if you can just follow me for a bit, is because they expect there will be more demand for bonds with a shorter duration. So when there is more demand for people to buy up bonds in the shorter duration, it's because they don't want to hold too long of a bond tenure, such that they might lose money, right? If the interest rate does go down. So under that type of scenario, we then ask ourselves, if the bond market and when the bond market is thinking about another potential rate cut, as we can see from the shorter term bond rates, what type of equities is most worth buying, right? So and then I zoom out into the following sectors in Malaysia. For those who follow US, for example, everyone know that if you have a rate cut potential, your crypto, your tech and your AI, all that will start to boom, right? That is something that we are very commonly known and we are comfortable of. But in the Malaysia context, what we notice is that if there is a sign that a further rate cut is needed, typically it is not those growthy areas that respond well. It is actually the small defensive, i.e., what we like to call the non-cyclicals that will do well. So utilities, for example, three times, except for the recession time, was up 6, 12, and 14%. That is followed by healthcare. So healthcare also did relatively well. Whereas, on the other hand, areas like financials and banks, in a very short term, say in the third quarter, where Kenanga believes that there is going to be a chance that short term rates will, on the bond side, hint at markets betting of a rate cut. We think that banks for the third quarter isn't going to be so great, although on a 12 months basis, we still have confidence. So having said that, I think what we really want to zoom into is the tariffs. What we have over here is just a simple snapshot of what we think the 25% tariff may mean, whether or not it's still mildly positive or mildly negative or broadly neutral. I have a lot of data and info here. I do not want to go into every single category, just maybe calling out the fact that it is mildly positive for consumers still. It is, however, in our view, broadly neutral to gloves, although we have been getting pushback on that idea, and I'll explain a bit later. Of course, one of our favorite sectors locally is tech. At the moment in the tech space, I will blow it up a little bit more to maybe discuss it in more detail, just to spend about 2 minutes here. Because when Kenanga follows and covers many players in the and tech cannot be generalized, is our conclusion. We have areas such as precision engineering, and you have fabricators, EMS, manufacturers, IC design, back-end semiconductor. They all have a different type of response to the tariffs. And if I may give you some examples, we speak to the likes of UWC, which are precision sheet metal manufacturers. We speak to the likes of Wentel, CPE Technology. They are more on precision engineering. We speak to the likes of Inari, etc., etc., to help form a view. So generally, in and precision engineering, the order outlook is relatively stable. They are still seeing the fact that the grand thematics of foundry still growing, hyperscalers still need to grow. They continue to benefit from front-end equipment ramp up. Likewise, also from fabricators. So let's say precision sheet metal, precision fabricators. Typically, what happens to these is that because whatever they are producing, let's say a metal part for a certain equipment, that equipment, the principal or the person who sells the equipment eventually to the US, they may get tariffed at a certain tariff rate, but the component itself right now, for example, might be just 1 or 2% of the entire machine's cost. So in such a negotiation and such a supply chain, typically there could be less pressure on these type of players. And I think right now, whilst they highlight to us that their customers, which are the fabricator of those machines, could ask them to share some pain of tariffs, it has not yet happened. Of course, on the EMS side, for those who do contract manufacturing per se, there is a little bit of a downside risk in that there is a thinking that our Malaysia rate the tariff needs to be at most 20% to stay competitive. So I think this is just to help investors online to sort of put a number to, how to think about EMS space right now and their expectation. Some of these EMS players also have previously expanded some facilities. So for that reason, if tariff differential becomes an issue, then we will be looking at future utilization difficulties. For IC design, like the likes of Opstar, we also cover it. For these type of names, while tariffs do not have a exact impact, the indirect impact of decision making being slow by customers is also happening. So that is something that we just like to flag. On back end semiconductor, at the moment, OSAT players, for example, there is a slight improvement in flow as we understand, but it wouldn't be very noticeable. Right. So from our view currently, when we look at the technology, the table on the right is actually quite useful. What we are saying is that in our independently, we canvas all the listed companies that are in tech in Vietnam, in Malaysia. You can see that the portion in Malaysia with the blue numbers are actually higher. It tells that there are more firms that have stronger EBITDA margins in Malaysia than in Vietnam. So if you just want to broad brush it, we can always have a backstop to say that so long as there is not too much of a difference, we can still even out or equal out some of these competitive tariffs that we are seeing moving ahead. Our 4.3% GDP forecast is unchanged after the rate cut. We think that this area of 4.3% GDP is going to be still very supported by a relatively favorable outcome scenario for Malaysia. If that doesn't happen, we may have to revisit our thesis. At the moment, we do think that ringgit will strengthen to the year end of 4.08, predicated on 2 rate cuts from the US Fed. We think inflation will be benign. I can take questions on SST, etc. But generally, inflation in the full year basis, we are expecting 1.7%. If one was to take a 10-year view, inflation has always been about 1.9. On a market basis, we think earnings growth will be at 3%. This is consistent with a 4% GDP growth. We don't think that we will see negative growth this year in market earnings, simply because we have done a bottom-up stress test of all the market constituents. We do have a belief that market will still end more than 1600 at the end of this year, although there could be some negatives if there was more earnings cut. One thing to note is also earnings cut from for the market after the first quarter was mainly dominated by selected stocks, and it wasn't broad-based. Okay, I'll spend the next 5 minutes to talk about strategy. Now, first of all, how to think about it for those who own a portfolio, especially to share what the Insti is thinking, and then look into the key sectors and thematics, which I'll go through. And without that, and I think that today the message here is for the market is not expensive, but definitely on valuations point of view, it is not as cheap as it was during April on Liberation Day. In the Liberation Day, the red line shows valuations of what is the returns required for owning the Malaysian stock market, right? So over all the past years, during pandemic, because the earnings had declined, the returns required was relatively high, and we did see that in Liberation Day. So of course, if they demand higher earnings, it means the market has is quite low. Today, market is no longer so low. Of course, we have rebounded to 1,500 levels, so it is no longer a buy everything strategy. When we look at the market, if we were just to then separate it into defensive and also cyclicals, what do we then observe, right? The defensive side of the market tended to hold up much better. This one on the left has healthcare. Healthcare, if I just strip out gloves and if it was just IHH and KPJ, it will be close to 100 as well. This is year-to-date movement of the various sectors. So if you're thinking about a portfolio perspective, this is useful because cyclicals tended to have recovered much better, number one. And not only that, the cyclical side also offer you more earnings despite the recovery. And this is very important. The reason is because today, as I mentioned, market expectation is the earnings is going to be about 3%. And in and around that, they also have to start to deploy money. So fund managers will probably be thinking, I will put the money where I believe that and I have conviction. And one of the ways to look at this is to look at earnings growth versus the valuation on a PE basis, right? So for each earnings growth unit, how much you're paying for. And if we were just to put all the sectors here and we draw a horizon line, we can see that certain sectors deserve to rate better. Above the horizon, things like construction are still very attractive, property as well, banks, which we also like, and planters is also here. Although planters, on a sequential quarter basis, we think that earnings might come off, so we are slightly more light on that. So over here, the cyclicals do offer better earnings for each unit of valuation. So within those momentum sectors, our key message to our fund managers is to look at the sector laggards, and therefore we do not bank table on the likes of uh, uh, I would say Gamuda, Tunaga, those have done really well. So the third quarter, we are looking more on the laggards such as Signprops, the likes of your YTL Power, CIMB, which we like over Maybank, IJM, which after we have downgraded Suncon, and also IHH, for example. So that is the third quarter strategy that we are going for. Inevitably, we can also write on how invest fund managers tend to think in this high geopolitical tension moment to look at certain sectors that can give us some hedging benefits. So the first one is how to hedge against geopolitics, and that this chart here, the blue one, is actually something called the Bloomberg Geopolitics Index. And when we see it spike, typically the current way of looking at it is some of the oil and gas names do provide some good uh, correlation. Means when there is higher geopolitics tension, some of these stocks do well. Historically, MISC is the one in this line, but more recently, Dialog also tended to respond well as a hedge for investors. So therefore, something to keep in mind. Secondly, another hedge is also a hedge against potential OPR card, if any. So investors will be thinking about deriving and locking in some value in some good dividend stocks. The names that we show here are qualified by having 2 years of earnings growth. So they when they have earnings growth, then we put into here. The red bar is actually free cash flow. Free cash flow is a way of us looking at the operating cash minus any capex requirement, right? So when we have that, it gives us a bit of a sense that you can generate enough cash to pay good dividends. So over here, these are our dividends portfolio. We believe that while year to date, REITs have been all the rage. Everybody buys REITs. We think REITs currently already reflect relatively rich valuations. So buying REITs will not give you any more upside unless in a pandemic scenario, we believe there's still about 10% more to go for the REIT sector. So, but that is not the view that we subscribe to. We think that for the free cash flow yield, we like to play dividends through telcos, which gives about 4% yield. The reason is because some of these have got special dividend potential, like Maxis and Timecom. The reason why is because currently we believe that the capex requirement for at least 2025 is not very clear yet. We have the rollout of the second network and a lot of question marks still on the DNB, which is our 5G first 5G network. So the capex requirements won't be very high, and therefore telcos will have the ability to pay out more dividends, and that's why we have them as our key dividends play. We also think certain names like LPI is our key picks, and also oil and gas, Valesto currently will probably give you close to 7%. So another name that we are promoting. From left to right is what we like to what we least like. In the previous years, previous quarter, we would have been very light on gloves, but this quarter we say that it's probably time to look back at it. Consensus earnings estimate is still a bit high. So in terms of timing of entry, we think it could be by results time to let the earnings recalibrate a bit. But generally, those that we have managed to speak to quite recently in terms of glove players already are seeing the rebound in volumes, and ASPs should be relatively stable. So that is the view. We like RE, construction, utilities, and banks. And for the over the quarter, we have lowered planters. For the next 10 minutes or so, I will just go through some of the sectors, and I will go by those that we get most questions from fund managers to perhaps the least questions. I think the key picks here, I won't really go through one by one, but I'll show over here as to why we picked them. And I'd just like to highlight that also on some of the contrarian names that we think it's a buy, where in MBM resources at these levels, and Sime Darby, the market expectation in earnings is still too high, so we have a sell. And some of the unrated names that we have here have also been promoted by the team, such as Amproserve, which is a downstream maintenance play, especially in during this time where oil and gas prices are not so strong. They will still have Pengerang will still have to carry out downstream maintenance. We also like Reach 10, which is a broadband player that could benefit from second 5G network rollout, as is Timecom, who can get the fiber connectivity packages. CPE Technology, another precision equipment maker that is part of front end tech at the moment. So these are just some of the names, and Sumi Saljana is a drilling fluid market leader that we quite like. I think having said that, I'll jump straight into some of the sectors. One of the sectors that have been getting a lot of traction with the fund managers is actually renewable energies. Within renewable energies, we believe that currently those names that were not winners of the previous LSS will likely stand a good chance in LSS 5 plus. We think anytime now they should be able to make awards, and we like the likes of Malakoff, Saipak, and they probably will partner the likes of EPCC partners such as SolarVest. And in that case, our current assessment is because there is going to be a huge increase, especially after the Kenanga latest tariffs, to push another round of strong demand into solar under the CREST program. We believe as well that these are combined factors why the EPCC space now, in terms of the pie, is growing again. So we like market leaders in this type of situation, and therefore we are pushing for SolarVest in this thematic, and we have a 271 target price, and it's not priced to perfection yet. Moving on from there, in the construction and DC space, what we know for now is that there should be at least moving forward about 15 billion of data center opportunities just in Spring Hill, which is in Seremban, as well as Elmina under Signprop, and also Eco World. In terms of timing, those under the latter would likely come out first. Those in Spring Hill and those who follow this story will know that the play here is Gamuda, mostly, that would be a 2026 play. In terms of the pecking order of DCs, I would say that currently construction side is almost all US hyperscalers. So under the new Trump administration versus his predecessor, we did see that right now, as in the data center space, and AI chips, so long as you buy and use American, it does seem like they are pleased with that, and they are trying to discourage use of any non-American chips. So in the game has changed such that now the idea is to for them to flood the market a bit more, and that's great so long as you're dealing more with the US side of things. So construction is almost all US hyperscalers. Property players, when they build out for Google, for Microsoft, and all that, is also built and leased with US. So there isn't that much of an issue. Um, less conviction probably in the cloud business, in a GPU as a service, likes of your YTL Power, SNS, because the US nowadays is able to now affect or influence who you put on the cloud. So that could increase a level of scrutiny. Likewise, increase in scrutiny we also see in NetGate. So we highlight some increased risk over there, which we like the least at the moment. Just a quick one on banks as well. The question right now is what is being priced in for banks? If we look at the market prices and we ask ourselves, what is the return on equity right now? This is the implied return on equity. And we think that at the moment, if we were just to work out what is the loans growth people are expecting, I'm happy to say that we are already pricing in pandemic level loans growth of 3.4%, which means that right now the expectation is already very low. We do think that if you are more conservative and you feel that there could be some downside, happy to show this chart that says if we worry about asset quality and impairments, those red ones are the ones that have more worry because the credit cost or the impairments assumption by the street or brokers in as explained by the blue star is still lower than what company is guiding as explained by the red star. The one that is more comfortable right now is RHB because brokers and the street have already given them a much higher expectation on impairments. So that is downside risk for you. At the moment, I would just like to call out a few more sectors and some of the things that we have been sharing with fund managers, and I'll round up with that. On the glove side, we meet with a lot of pushback because of Indonesia having a lower rate, and people are wondering how much more the Chinese will then push the production to Indonesia and Vietnam. Number one, we note that in Vietnam right now, it's just about 2% of total capacity that is going to be met out of there. And we note as well that the ramp up might take time, number one. Number two, in terms of selling prices, because the dynamics there isn't same as producing out of China, we understand that even in Indonesia, the selling price would likely be about 16 US dollars per thousand pieces. And that shouldn't have a huge influence on the current ASPs as well, if that is the concern on pricing. So, of course, Top Glove probably has a stronger Q-on-Q guidance where they're guiding on a quarterly basis a teens improvement in their volumes, whereas Hata, for example, is maybe up to 5% sort of level, more accurately about 3. So I think the idea here is the narrative should be shifting from previously Chinese stealing their volumes to now the volumes are coming back. But as to the timing of acquiring, personally, I think the forecast of the street is still slightly high. So I'll wait until it being recalibrated and then take a position. I think the other thing that I want to highlight is oil and gas. Oil and gas, our analysts have been quite prominent in this space. We still like Keyfield. We think the earnings delivery will come through. Valesto for balance sheet and a 7% yield. But overall, we think the thesis here and for 64 per barrel oil price is there. It doesn't have any pushback. We believe because OPEC will still be more inclined to increase volumes, it is definitely a time to play dialogue, which tend to benefit from a volume increase rather than ASP or selling price increase. So that is our key pick alongside MISC, which I've explained previously because petroleum tanker rates tend to also increase in tandem. What more with political tension, geopolitical tension. So that's on oil and gas. The other questions that we get a little bit more is on aut- ports. I think the reason why ports jump out as an area is because all of us know that MMC is trying to list their ports again, and the questions in and around valuations become very pertinent because if you read the papers and quoting the multiples that they want, it's going to be more rich than the ones that you can buy today, like Westports. So on that end, we believe that there's still upside because the valuations wanted by MMC is going to help re-rate some of the names like Westport as well. So those are some of the key sectors that investors have discussed. I will round up with telco. So telco is not a sector that I normally explain here, but because right now we are looking at second network rollout, right? Meaning to say that U Mobile, who has gotten the 5G spectrum, might roll this out. So the question is, who will be beneficiaries where you can actually play it through some of these infra rollout. We think Time.com will be one on fiber connectivity, for there is a remaining of 30% of 5G sites that haven't been installed at the moment. We think that Axiata via e.co could be useful in upgrading any in-building sort of coverages. And also for if you are interested in Reach 10, which is a Sarawak name, they should be able to snag all these contracts and tower sharing contracts in Sarawak as well. So I think these are just some of the names. We have also highlighted other engineering firms on network infrastructure such as Redtone, Hexcap, and also Tita as some of the names that we have been discussing with our fund managers. So I think I'll just stop there first after having given you a walkthrough of what has been happening in the third quarter, and I would say a very quick and concise roundup of what the institutional investors are thinking, and hopefully that was helpful for you. Yeah, over to you, Adrian.
Wow, Peter, I'm totally engrossed in what you are sharing, and seems like it's time to buy.
That's the whole reason you brought me on, right?
Yeah, I mean, there's so much to digest looking at the volatility, the instability of the market, and yeah. So I got some questions to actually check with you on like dialogue. I mean, before we jump on the webinar, we had this quick conversation, but it was just too quick. Looking at how these input costs for the petrochemicals are actually looking to stay at the crude is looking at 60 over. And today the reaction from Lotte and PChem is a bit obnoxious the way it was traded. Do you foresee if there's any potential in that scene for
Yeah.
the petrochemical players?
Yeah. I think right now, for those who follow Lotte and PCAM, we know the main difference between these two is their inputs, right? So what goes in, right? What goes into Lotte is what we normally call naphtha based, which is oil based, right? So their feed is actually oil based, whereby PCAM is what we normally like to call a more not oil based, which is gas based, right? And they have a agreement with Petronas for that fixed supply. So I think even our in our presentations with fund managers over the past 1-2 weeks, even institute fund managers are also scratching their heads and asking why has there been a relatively strong movement, more so for Lotte. We think the play here is perhaps a loss narrowing narrative. So how they
Mm,
normally make money is through a spread, right? So meaning to
yep.
say that the spread between what they sell, i.e. the petrochemical prices and their input. And if the naphtha price, for example, right now, because of the weak oil price, and that that spread will actually increase faster than, let's say, the likes of PCAM. In this type of situation, typically people will take a view or take a punt that losses will be narrowing. And I think that's what's happening at Lotte at the moment.
Ah, cool, cool. So
Yeah,
let's
yeah.
see. From
Mm,
today's participation and closing, I think is quite strong. Probably we not might not for those that might be interested in the short-term trade can take a quick look, but investment wise, I think we would want to monitor a bit more. That should
mm.
sound a bit more right, right?
Yeah, yeah, I think so too, because at the moment our analysts also believes that it is a little bit too early to say that there would be recovery at the selling prices of petrochemicals. But of course, the more specific to Lotte could also be the feed, right, which is the
Yep.
inputs. Yeah, yeah.
Okay, so let's look at some of the questions from the floor in the chat box where take the first one from ding 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 ding. Sui Hong Kang. This is the first time I see your name popping up. Are you joining us for the first time, or have you been joining us? So, Sui is asking, solar stocks have rallied March. Any further upside? Straightforward.
Did you say Solar Vest?
Solar stocks have rallied March.
Solar stocks. Yes, yes. Okay. Yeah. Yes, we think there is further upside. Based on our current target prices versus closing prices, it is between 15 to 20%, based on our assessment of SolarVest and also Pecat. Uh, both of these we do like. The difference between Pecat and Solar Vest, depending on your appetite, Pecat doesn't really like to be an asset owner, number one. So they normally are also a little bit more cautious, and that
Mm,
they will try to go for more margin buffers. Whereas Solar Vest, the leader over here, likes to have a combination of being asset owner as well as EPCC. So moving forward, what we are seeing in this space is some of the LSS 5 plus winners, which we believe should be announced soon. We think that within them, amongst them, Malakoff and Solarvest bid may be one of the winners. We also think that, for example, SciPark is also going to be among one of the winners, as well as SDG. Now, the reason why we say this is because we
mm,
believe that, versus the previous awards, which were lower in Bumiputra representation, some of these names that I just mentioned are more Bumiputra in terms of their nature, and therefore, because they want to have a higher participation in these categories, that would be the likely scenario. So we think that the likelihood for them to win the job is high. Let's say if I was to quote SolarVest, currently the order book potential is more than doubled to 3 billion. The reason because the newest LSS 5 Plus, for example, the expectation is for the awards to be larger in individual size. If in the past the play was to buy everything because everyone
mm.
will get something, the current play is more of a certain names will get larger allocation. So the ability to correctly choose some of these winners become more important, and we believe in this environment, SolarVest is the one to own.
Yep, I think we discussed this topic even with Nigel's session last month, where
Yes,
looking at the other smaller players, it's better to bet on the bigger ones.
yeah,
For a
yeah,
start, I mean, there's no point to go for the smaller players, partly because the margins aren't there, the unique USP is not there for them. is
Yeah,
as opposed to Solabas and Percat, right? Percat at least has their own edge apart from just EPCC contractor.
correct,
So
correct.
coming back, just to circle around, talking about IPO, right? Um, you highlighted about nProServe, and I'm glad that for those clients that have managed to apply for nProServe through our e-IPO, congratulations. I think it's one of the very few that have performed. But do you think that with the shutdown and also plant maintenance that is kicking in, it will be a big growth factor for nProServe that could potentially, in 1 year time, re-rate its multiple?
Yeah, that's a good question. I think the realities is that for those who follow this IPO, currently what is happening, if we were just to take a step back, was a lot of these Pengerang facilities actually have been constructed since 2019, right? And that means that usually if they think about the so-called more major sort of plant turnaround or plant maintenance that happens every 5 years, right? So right now, what we are seeing is that the likelihood, if we just were to track some of these large plant turnarounds that will have to take place in Pengerang, regardless of oil price and all that, right? You just have to go through those maintenance. That is likely to start to crescendo and grow over FY26 and more evidently in FY27. So
Yeah.
what we are looking at it here is that this will give us a runway of at least 2 year sort of stock, I would say. No, it is not a stock that we will promote for a very short term type of horizon, but we think that the growth, if you can hold it to 27, is when you will see a more exponential growth based on how we believe the maintenance schedule will take place. Therefore, to your question, Adrian, whether or not the multiple re-rating will be immediate, my own personal hunch is maybe no, but I think
Mm.
the consistency because of the visibility will help the multiple continue to expand is what I'm hoping for.
Yeah, I think for a start, for a company that just went IPO, I totally agree with you. At the current multiple, that it should see a bit more gradual movement.
Mm,
Uh,
mm, mm.
totally. So let's
But
look
yeah,
at some of the
but
questions.
it does fit into the whole maintenance and downstream
Yep,
thematic lah. Yeah,
yep,
that's a because it's a pure play. Unlike dialogue, they wouldn't give you the exposure. So if somebody wants a more pure play sort of exposure to downstream, that's the name that you can invest. Yeah.
yep. And they're not just limiting themselves to just oil and gas, because oil and
Mm,
gas
mm,
was the most technical, so facility management
yeah.
players around the region could be under threat also if they go big on that. That's how I see
Mm,
things.
right, right. Yeah.
So, okay, coming back to some of the questions from the floor from Kokwa, is Malaysia able to deal with American to reduce its tariff to 20%? This is, I mean, I guess we need to get a hotline to Trump, right?
Yeah, I think this is quite a developing risk, right? Because what I think I saw the news today, Tengku Zafrul did say that the ball is not in his court to determine that final number, and he didn't say that 20% is exactly going to be where he lands, lah, right? So I think from that sort of verbiage, it does feel that things are a little bit fluid. I think before I answer that question of can we get it, maybe I'll just preface by saying that in our conversations, especially with the tech side in Penang and all that, those players believe that so long as the difference is within 1-2 percentage versus our peers, it should be neutral, right? As long as we get to that level. And just now, I also have charts to show that broadly our EBITDA margins are strong versus the region as well in the tech space. Whether we can actually do it depends on what we have to offer and do they actually want what we have on offer is what I'm saying. Let's say, for example, Philippines, right? So Philippines now, I'm not a geopolitics analyst, but I think they have made themselves more of a, like a open to, US coming into Philippines, make it easier for them to sort of also control the geopolitics in that area, right? Close to South
Yes.
China Sea and China. So if you want to subscribe to that view, they have to give up a lot to get the reductions. And of course, for Malaysia, we know what we have. We have rare earth. We have a lot of deposits of rare earth. And the question is whether or not this can also be used as one of the negotiation tactics. Personally, I think at this juncture, there have been a lot of red lines that Tengku Zafrul have mentioned they shouldn't be crossing, and I would not expect them to back out on that wording. We do think that currently there could be some uh, compromises to bring that number down a bit, especially in opening up some of our industries, which in the past may not have been mature, but today are more mature. And in saying that, I'm saying that we are already liberalizing some of these industries, so we can take it a bit further. In my personal opinion, for example, banking ownership, right? So maybe in the years past, our banking system was not strong enough to have a huge foreign bank come in that will crush everybody else. But today we are more mature. So why be that restrictive still in some of the ownership? And we have seen that sort of like we have changed with the times in terms of the industry, but we haven't changed the rules of the game, right? So I think
Yep.
it's perfectly fine to really explore some of these to move ahead as we try to liberalize more even as a business. So I personally see that could be an area that some wins can be achieved. Whether or not we can fully push it down, I'm hopeful. But we
Fingers
will have
crossed.
to we will remain to be seen.
Okay. I love that. I mean, we do have foreign banks like Citi that never sleeps and was putting themselves to sleep right recently, but
Yeah,
you get
yeah, yeah,
make it
yeah.
fun.
That's right.
Yeah. So one more question from this is a very unique name, Adrian, Yvonne, and Angela. I always love this uh, follower here because it always put the loved ones together. What would be your top three picks in the tech sector, excluding Nation Gate? I think Nation Gate has becoming a bit more seen more volatility in recent times. Yeah, but yeah, excluding Nation Gate, what would you be picking top three?
Right, right. I think at the moment, Nation Gate, we do have a 2 ringgit, slightly more than 2 ringgit target price. So in all the conversations that I can share with you, is that fund managers do treat this slightly more like a trading stock at the moment, and I think for good reason because the tech space still has semiconductor related tariffs as well as specific to Netgate. Right now, US is trying to tighten some of the rules for AI export, right, especially to Malaysia and Thailand. So that's why we also think that we fade into gains if we and take a shorter term view. We like Killington. We have at the moment looked at it as what is a play that gives visibility on earnings to fund managers. That is perhaps the most important. So, regardless of what happens in the tariff itself, you still have to construct your plant, right? So, your plant construction for front end wafer fab, you still need to build that. So that's why we have continued to like Killington. We have been liking it for the past 4 5 months, and we still think that is one to look at. In and around the same space, we also recently highlighted CPE technology because they create a component in a larger machine that is being used in the wafer fab as well. So this is a gas system. So they manufacture one of the components that goes into the gas system. So admittedly, it is a little bit that you need to use your imagination, but they are all linked back to front end and wafer fab proxy. So I think things like that is what we do. Like obviously, the ones that are quite obvious in the market, we unfortunately do not cover. I think a lot of investors like the likes of Frontcan, that are proxies to TSMC, and those who follow TSMC will know those are doing very well. I think those look pretty interesting in my view. So just a few names to call out right here. Some of the names we think are valuable, but currently there is more risk than that we like Inari and SKP Resources. These are also names that fundamentally we think that they are valuable, but we cannot discount the risk in the near term because of all these tariffs. So we will take a trading view as well.
Okay. There's one question that is gonna relate to one of the hotter topics where the dude that just burned 1 million. This is a question from Wilton.
Yeah,
Suncon's dip, is it a good buy since the MACC case,
yeah.
or should we wait a bit more just for it to settle now?
Yeah, okay, that's a very good question, and thanks for bringing it up. Internally, we know for those data centers that Suncon is tendering, and this is different from directly negotiated lah. I think tendering, as far as we know, and I believe they are looking at 4 data centers, um, which have not been awarded, right? So for those who have not been following the case, what has happened is Suncon put out a BOSA announcement to say that one of the employee is being investigated. Of course, when putting two and two together, one can make the conclusion that it is linked to that Johor data center bribery, right? Although they never explicitly say that. So their share price dropped 18% at one point and closed at about 9% down. They also held a briefing. We believe that at the moment, if we were to fully discount all the 4 data centers that they are looking at, assuming that that doesn't come in this year and next year will be also impacted, the drop date price is 4 ringgit and 84 cent. So at that price, right, it's completely no more data centers in the near term, right? We believe that the market will not be so quick to derate Suncon because Suncon has always been very strong in governance, and this
Yep.
and therefore we think about 22 times our PE is what anchors our 484. Currently at about 520, 530, I think it's a bit Goldilocks. It's neither too cheap that we say it's bank table, neither is it fully priced in. I would say that on the margin, some of the investors I speak to, especially those more MNC type, will say that right now they have a ESG flag on this name, and therefore they cannot add new positions as well. So this also cascade down to some trading activity. Long story short, I believe if it is closer to 5 ringgit, it's value territory for us. Currently, our target price is 5 ringgit and 70 cents. To be more specific, 5 ringgit and 66. At about 530, 540, I don't think the upside is worth it.
Can't bang the table. I mean, below 5, I'll
Yeah,
be tapping the table a bit, right? I think
yeah,
the
yeah,
selling
yeah.
pressure, I think, is still a bit there. So probably in the shorter term, we can observe for it, but not
Y-
be too
Yeah,
crazy.
correct. I think the play here therefore is to look at the alternatives lah, right? Like Gamuda and IJM. I think the big picture thinking here is perhaps Suncon is also interested to see whether they can get other data centers where maybe Pearl Computing, Spring Hill is trying to develop. There's 7 or 8 data centers there. So the way that we think about it is one man's loss is another man's gain. So therefore, it does help us reinforce our conviction on Gamuda and also the laggard, which is IJM, right? Yeah.
Speaking of data center player, what do you think about Binastra?
I think right now, not really something that I get a lot of questions from our insti fund managers at the moment. Definitely, I think when we look at it more from a what I'll call second liners level, maybe the thinking here is there is still a lot more interest and M&E play. Right, so
Okay.
M&E play seem to give more risk reward. So I think investors, when they look at it, will look at names like MN Holdings and all that that provide an M&E exposure to data centers. So I feel like at the moment, the way that I believe the market looks at it is that for actual core and shell data centers, there's it's still this few big
Yep.
caps that people gravitate to. Otherwise, they will play the M&E side, and that those you can have various exposures, whether you want to go through MN Holdings, or you want to play through the switchgear side, so those are other options you can have as well.
Peter, do you notice something tonight? Our followers in our audience tonight has been very punchy and very forward. The question that we asked right tonight is, give me a top three pick in this sector. Give me a
Yeah,
top three pick in this sector. And the
why
next
not?
one is going to come from Jit Raj. What's your top three pick from the banking stocks?
Yeah, okay. Thanks for that question. Banking is, after all, a very significant part of most people's portfolio. At the moment, we believe that in our very few conversations with the banks, the assessment on the ground seems to be that there is a little bit caution on the SME side and the personal loan side. So banks are slightly more cautious, and that is a function of just anticipating some risk without seeing that risk already on their books, right? So what we are going to see right now for the a person who asked the question, I believe the market will start to only re-rate the banks once in the second quarter. The banks so-called recalibrate or confirm that things are okay, right? When they
Yep.
actually hear that things are okay, and they have done their assessment, their exposures to trade-related loans, etc., etc., is not excessive. So I think once the market gets that confidence again, it will only start to move up. At the moment, because of the environment we are today, where the loan growth is not so strong, what is the second order effect of that? The loan pipeline is not so great, will also normally mean that there is a bit of a pressure on loan yield, meaning to say the asset yield, where there is more banks chasing the same pool of customers. So we do not like banks that have very high loan growth target. So therefore, those banks that do not have market share goals are the ones that we think are more able to deliver satisfactory numbers. And for that, MBank, we think that they do not chase market share. They only play in selective places, and also they are able to increase their dividends over time. Number two is CIMB. We like CIMB because also they do not chase market share, and we believe currently at about 650 that also already prices in a very low expectation in Indonesia growth. Therefore, we think it is priced in, and these are the two names we are pushing ahead of Maybank. Overall, we think these are the three banks that we like. And if one was to look at dividends, then LPI and RHB are the ones that we are pushing. Yeah.
Okay. I mean, I love the crowd tonight, and the the format of question are just straight to the point, and this is just fantastic. Let's see if we have any more questions before we move on to Isabel's session. So far, what about Sunview? Probably you take that as a last question.
Yeah, so far as I understand from analysts, Sunview, uh, there are the number of interests from fund managers isn't that high. I think, but uh, we think that Sunview should also be one of the potential winners in upcoming LSS5 Plus. If my channel checks are correct, they also have a tie-up and a JV with one of the players to roll out together as an asset owner of LSS5 Plus, and then after that, of course, the EPCC side, they will be able to capture them. So if you just ask from a news flow potential, we do think that in the near term there could be positive surprise, but unfortunately, because I don't cover it, I don't have the numbers in front of me to be able to confidently say where the fair value is, and I apologize for that. Yeah.
Okay.
Mm.
Probably I think there's only one last question from Benny, and I think we need to move on from there.
Yeah.
Is there any company that you particularly want to look out for the Johor SEZ team?
Yeah. Yeah. The Johor SEZ team currently definitely I was just there about 2 weeks ago to visit the property developers and also to talk to some of the infra providers. Currently, we have the confidence that the demand in Johor is real, especially when we look at the land banking, the selling price for data center related lands have actually climbed up to about 80 ringgit per square feet, which is really, really high. And for what is now happening is there is a bit of a spillover effect, meaning to say that not only those near JB or near the RTS station, we see asking prices for properties, for example, now it's as high as 1,250 per square feet if you're nearby there. But we are starting to see some of the spillover into other areas as well, Tebrau side and further up as well. So I think generally we are seeing a bit of a improvement overall, and it's relatively broad based. So I would say Johor property plays is definitely still in play. We Number two, once we are comfortable with the Johor property players, the names that are a bit more aggressive there at the moment, we have met those. Of course, favorites will be like Sunway, right? But at the same time, we also met the likes of UEM Sunrise. We met the likes of Marsing, and all of them do report that things are still looking up. I think the other thematic, other than just looking at property, will also be connectivity. So in the connectivity team, we haven't done enough work on it, but we also met HI Mobility, the company that runs the Causeway Link bus. So that
Yellow
one,
bus.
yeah, the yellow bus, which also looks to be able to provide investors exposure to when the RTS is completed, then there needs to be a last mile, right? So if you take the view that RTS is going to increase significantly the people that cross over regularly, then this will increase their pie as well of addressable customers in which that they need to go to the last mile. And right now we all know that in Johor, last mile is still an issue, right? We don't have LRT, we don't have ART. So I think for the near term, they are in somewhat a sweet spot, if I may say it that way. But I haven't done my numbers, but I've met that company, which looks quite interesting. Yeah.
Okay, that's a good last tip to actually look at. Look high. I mean, high mobility. But yeah, I think without further ado, we can actually invite Isabelle to this
Okay.
to
Yeah.
share her
Sure.
tips on how to maximize in the market. And to answer everyone's question on the slide, we are not sharing the slides. But what you can do, I give you a tip: log into your Kentrade. Here, Peter's strategy report, which is more detailed, is actually inside there. And yes, the slide could be an essence, but the gist of the good read is actually in your Kentrade. It's actually within your palm. You actually can log into your mobile app too. We have e-IPOs and very great research report, which I always refer to before I actually confirm my technical ideas. Yeah, so kudos to Peter and team for being the most extensive, having the most extensive coverage in town. Yeah, so hi, Isabelle.
Right. Peter, thank you for the session. Great haircut. And since Peter brought up Sabah, I was wondering whether there are any Sabah and Sarawakians in the house and whether you'd be interested in meeting Peter over the next few months. We're planning to do a Sabah Sarawak event. So if you're from Sabah or Sarawak and your town, can you just put it into the chat if that's where you're from? All right.
Tonight's special, we top up time a bit. So Isabelle, you need to work OT a bit.
When do we not, right?
Yeah.
All right. Do you see my slides, Adrian?
Hold on. Not yet. Not yet. Nope. Hi, Susie.
Hey, Susie. Adrian, I'll send you my slides on Telegram. It seems our company has done the same thing again, even though we've already sorted it out.
Drop me through email. I can
Thank
actually.
you. Yeah, Telegram. All right. Anywho, today we're going to cover a tiny bit more on Hang Seng Tech and Hang Seng CEI. So we've launched two new warrants on Hang Seng Tech, Hang Seng CEI, and I'm going to cover a bit more detail onto the differences between all three indexes. So Hang Seng HSI is something that we're all familiar with. It's already got a broad base, it's the benchmark for Hong Kong. And the second one is Hang Seng Tech. Now, Hang Seng Tech is slightly more complicated because there is a sector recommendation which Hang Seng does put into place. And finally, Hang Seng CEI, which is weighted more towards China stocks as well. And if Adrian has already covered it earlier, we do have three campaigns that we're running at the moment. We've got our Visit SGX 2025, where you can get a 10% cash back. We've also got our Wake Up to Gold campaign, which is extremely successful. We're giving away these gold coins. And what happens is for the first 600 people that actually reactivate their inactive accounts, and you trade and you get you actually hit a brokerage of about 128 and above, you will get our limited edition Kenanga gold coins. They're really cool. We've already given away more than 100, so we got 500 more. We just started this campaign over the last 2 months. And finally, for our KDI, we also have a KDI Gold Rush. And what happens is you deposit a minimum of 1,000 ringgit into KDI and you stand a chance to win a gold coin worth 150 ringgit.
Give me a second. Coming up. The file is a bit huge.
No problem. I know. It's only 13 slides anyway. Our organization likes to lock us out of things, even though it's already fixed.
Safety. Hold on. Coming online. All right.
Thank you, Adrian.
All right.
All right. So let's get to that disclaimer page. Thank you,
Adrian. I covered disclaimer
earlier,
earlier, so probably we can just go on with it.
Super. So what you really need to know from this page, if you can maximize the full screen, Adrian, that'd be great. Because my eyesight is as terrible with a power of 1,000. I'm almost blind over here. That's what you get for being a warrant issuer for 9 years. You are legally blind. And you're looking at 4 decimal points. All right, next.
Okay.
The most important part for this slide really is that Adrian holds a IA license. He holds an investment advisor license, and I hold a CMSRL dealing module 6 and 7 license. So we're both licensed to give these talks. Next, please.
Awards.
And these are the awards we've won. Not to brag, but just that we hold ourselves to an international standard. And that's what we're very happy with. Not just a Malaysian only standard, all right, but international standard. All right, next. These are the 6 warrants that we've issued, brand new. As you can see over there, these are our
Hold on.
it's okay, Adrian. These are our 6 warrants. We've got the Hang Seng CEI, CAA, the HBA, which is a put, HS Tech C30, HS Tech H27, and HSI CWEY, and HSI PWFZ. If you forget, the black ones are call warrants and the pink ones are put warrants. The only reason that's the color is because I like black pink. So black for calls, P for puts. Next.
Easy to understand.
I entertain myself, right? It's clear that I do the website, the mechanisms of the website. All right, so today we're going to cover the whole family of Hang Seng indices, and we've got 1, 2, 3, 4, 5, 6, 7. There are 7 main themes, 7 main children in the Hang Seng family, but we only look at the benchmark, the flagship index, which are these 3, the HSI, the HSCEI, and the Hang Seng Tech. As you can see, Hang Seng has a whole other list of siblings, which is the market indexes, the sector indices, the sustainability indices, the factor indices, which looks at dividend yield, quality, volatility, momentum, size, and value, the strategy index and the global index. But the flagship, the benchmark, the sterling top shelf, most popular index for Hang Seng are these 3. Next, please. So in typical Isabelle fashion, I'm going to cover Hang Seng Index followed by the 2 others, but I've simplified everything. If you'd like a bit more nuanced version of this, we have a webinar that was conducted by our speaker from Hang Seng about 2 weeks ago. As we launched these products, we actually had a nice juicy session from him, but his was about a 1-hour session, but I just tried to add a bit more things and make it more interesting for you guys. So Hang Seng Index. Objective, to monitor the overall performance of the Hong Kong stock market, the universe, constituents of Hang Seng Composite large and mid-cap indices. Now, the red color ones are what's the different ones. I highlighted it nicely. 85 constituents expanding to 100. That's the first difference. Review schedule is every quarter, which is the same across all 3. The capping for HSI is 8%, and Hang Seng CEI is 8% as well. Only Hang Seng Tech is 10%. And finally, the launch dates are different, so you don't have to worry about that. Now, the reason I highlighted the orange there on the right is because these are stocks or constituents that are not available in any other index. So HSI now has this really weird thing. Sorry, not weird, okay? It is unique. So Hong Kong Exchange has this unique feature where they love to put alphabets on the back of things. And for a person like me who needs to know everything because I'm kiasu in that way, I asked myself the first question right at the bottom. Dear Isabelle, I forecast that you guys will ask me this question, so I answered for you, okay? Dear Isabelle, what does the W mean? For example, you can see at number 3, Baba W, Xiaomi W, Meituan W. W stands for weighted voting rights. Next question, Isabelle. Why they make it so complicated? Why must I have the W? Malaysia don't have W, SW, B, A, all these letters. The reason for the W is because founders want to keep control. And number 2, it attracts investors without giving up decision-making powers. And number 3, this scheme of dual class shares, the weighted voting rights, it gives the voters more votes per share, certain voters. So they get to maintain control over the company. And it's very popular with tech and innovative firms. Now you can see that these top 10 companies, they weight about 55.76% at the bottom. Next slide. Hang Seng CEI. Now Hang Seng CEI, the small difference is that it has a few differences over there where it says that The securities listed on main board of Hong Kong Exchange, excluding staple securities, foreign companies, biotech companies with stock names ending with B marker. Number of constituents, 50, fixed. There is no expansion to 100. Review schedule is the same every quarter. Capping is always the same as before, 8% on the individual constituents, and launch date, of course, doesn't matter so much to you, but it does matter if you want to do a long-term projection on the Fibonacci. So, dear Isabelle, second question for the night to ask myself. I'll aim to finish at 11:35. I will do my best. 9:35. I'll do my best. What does the B mean? Just now I mentioned biotech companies with stock names ending with the marker B. Now, B for Hong Kong Exchange, it means for Hang Seng indices, it means pre-revenue biotech companies. So why does Hang Seng Index allow this? It's because some biotech companies, they want to raise capital. And what happens is they are pre-revenue. They haven't actually made any money yet, but they already want to raise, right? We've heard this story many times. And secondly, it is because they would otherwise list in the US. So for Hong Kong, they want to be competitive and not allow them to raise elsewhere. So they quickly go and say, all right, we let you raise in Hong Kong. Just like you need to put a little B at the end for biotech companies only. Not every company can do this, only biotech. So B is for biotech, if you want to remember it that way. The two companies that are in this top 10 is Bank of China and Ping An, which I've highlighted in yellow over there. Next slide. And Hang Seng Tech. Now, this is our favorite. It's been issued in Malaysia before. Hang Seng CI is, for us, our first, and Hang Seng Tech is also our first. But Hang Seng Tech tracks the top 30 largest companies. All right. The universe, you can read yourself. Sector requirements. Now, this is different. For the other two indexes, they don't have sector requirements. But for the Hang Seng Tech Index, there is industrials, consumer, healthcare, financials, and IT. 30 constituents are fixed. Like I mentioned, the pink color that I highlighted over there in the slides, it is deliberate because I want you to pay attention to those. Those are the ones that differentiates it from the other two flagship benchmark indexes. Difference is the capping on this one is 10%. And the blue color, another letter that we have to learn. What does the S and SW mean? So for S, it means secondary listing. Quite clear. We all are very familiar with that. If there's a primary listing in the States, then there's a secondary listing in Hong Kong, for example, right?
Can I try for the SW?
I no, because you will know the answer. You're a smart dude. Let's let our
Susie Wong
viewers answer.
from Kuching or Sapu Wang. Okay.
All right. So, okay, it's not Susie Wong. Nice try. Do you want to try another time? You can give one of your silly answers. I'm going to let our people joining us here today. The answer was in the beginning. What does SW stand for? To see if you pay attention. And it's not structured warrants.
Sapu Wang.
Then there should be SW on all, right? All right. Anybody listening here, you'd like to try? What's SW? Just for fun.
Anyone? Okay, they turn out a bit shy now.
Secondary weighted. Who was it that answered? Benny, was it?
Yep,
You
Benny.
are absolutely correct. You paid attention to my first slide just now. Next slide, Adrian.
Okay, coming.
Yes. So S means secondary listing, and SW means it's a secondary listing plus weighted voting rights, just like JD.com number 7 there in the slides. So that is a nice quick summary. Since we're running out of time, next session that I have with you guys next month, I'm going to go into even more detail about the 3 different indices we have over there. And just to remember, because I have a technical difficulty today, thank you very much, IT. I'm going to show you on my iPad over here. For those of you trading, you need to remember that there are 3 different indices, as you can read over there. If you're tagging to it, there's HXSI, And remember, if you are trading this one, which is your Hang Seng Tech Index, the code that you want to follow is HTI exclamation point to know that it's your current contract. And for HSCEI, it is not HSCEI you're looking for. It is HHI. Do you see that at the bottom? It is HHI. So for Hang Seng Tech, it is HTI. For HSCI, it is HHI. I'll put this all on our Telegram for Naga Warrants, just to remember that these are the contracts you need to follow. And that wraps it up for my 10-minute 3 indexes for Hong Kong warrant. For Hong Kong. And happy trading. Have a lovely night. Thank you, Adrian, for helping me with the slides once again.
I mean, that 10 minutes is a power punch. Now I know. Now I get to know the Hong Kong market a lot better, and also know how to sapu wang. Like joke. SW, yeah, that's very informational. And yeah, we are at the tail end of our session tonight, and I'd like to wrap this up on a few key points. Firstly, I need to thank all of you for OTing with us, Peter, Isabelle, myself, and for giving yourself that chance to invest in yourself for knowledge. And while investing in yourself, for those that have been asking for the slides for tonight, you can actually check out in your Kentrade to download Peter's third quarter strategy report, which is a lot more detailed there. I took it as a bedtime reading. I gained so much knowledge and his viewpoint. And yes, you can apply for IPO through Kentrade now. So very cool. And you know if that can apply or not, because you might find us on TikTok doing some cool stuff with it, right? So nonetheless, keep track with us very closely. We have more in the store coming in the next few months and few weeks. All right, without dragging on, thanks, Peter. Thanks, Isabelle.
Thank you, everyone. See you next quarter.
Thanks, guys. You guys are fun, top 3 and just, secondary weighted. Thanks, Benny. Okay, good night, guys. Bye.